Hello and welcome to the lecture covering an introduction to journal entries and asset-related transactions. Before you start, I'd recommend going on Moodle, and in the course materials section for our class on Moodle, you'll find a spreadsheet at the bottom of that section entitled Blank Accounting Templates. This is a really good spreadsheet to save to a local drive because it's something that you'll find useful in the future. There's a bunch of things there that you can use for a variety of purposes that would keep you having to kind of recreate the wheel. I'd recommend that you print a couple copies of the first tab on that spreadsheet, the journal entry form, and have that handy as we walk through this lecture. At a couple of points, I'll ask you to pause the video, record some entries, and then unpause, go to the next slide, and see what the entry is. So this lecture and the ones that follow for the next couple of weeks should largely be review. It's really just an exercise in getting everybody up to the same point in terms of a level of comfort and understanding with journalizing entries specifically. I'll start out by talking about the rules of debits and credits, and I'll explain it three different ways in the hope that one of the ways will stick with you. Talk a little bit about how to interpret transactions. As you well know from your past accounting classes, you'll be given a transaction that's in narrative form, and you'll need to convert that to a journal entry. So I'll talk about that process. I'll talk a little bit about the format for journal entries, and I am kind of a stickler on this, so there are rules to follow that are important. I'll talk about cash-related transactions, receivable-related transactions, prepaid asset-related transactions, inventory transactions, and then fixed asset transactions. So you can see I'm just walking down the asset side of the balance sheet. So to start with, in terms of recording transactions, T accounts are a very useful way to kind of form a picture of what you're doing in different accounts, what the flow is, and making sure that the entry is balanced. Especially complicated entries where there are multiple moving parts to them, it's a good idea to use that. So one way to explain the rules of debits and credits is to do that through T accounts. So for assets, I'll explain that on the next slide. In this point here, I'm just making the issue that the debit is the left side and the credit is the right side. Debit left, credit right, regardless of the type of account that we're talking about. In terms of rules of debits and credits, I'll first just explain them and then I'll give you a couple ways to remember them. So first of all, increases in assets are recorded on the debit or left side. So in this case, this company received $25,000 in cash. They later received another $7,500 in cash. And then they had 4 transactions where cash left the business. The cash or balance in this asset was decreased with a credit. So assets increase with a debit, which means by default they decrease with a credit. Adding up the debits, subtracting the credits, I can see that this account has a debit balance, a balance on the debit side. I'll use the term normal balance for an account. The normal balance for an asset is a debit. So the normal balance equals the side that would increase that account. So I would expect assets to have debit balances. If I had an asset with a credit balance, unless it was a contra account, we'll talk about that later, then something might be wrong. Example, if I had a credit balance in office furniture, that can't happen, right? Increases in liabilities then are recorded on the credit side, and decreases are on the debit side. When it comes to stockholders' equity, the category as a whole will increase with the credit side and decrease on the debit side. So the components that feed stockholders' equity are going to follow those same rules. So an increase in revenue, which pulls up stockholders' equity, would be recorded with a credit. An increase in an expense, which pulls down stockholders' equity, would be recorded on the debit side. And then increases in dividends, which pull down stockholders' equity, would increase on the debit side as well. So those are the rules, just straight up telling you them. So a couple of other ways to remember them. One is the accounting tree. So we have assets on one side equals liabilities plus stockholders' equity on the other side. So what the company owns and claims on what they own on either side of the equal sign. So in this case, the left side of the equal sign is going to increase with a debit. The right side will increase with a credit. So I've broken down stockholders' equity into prepaid capital, retained earnings. They both also increase with a credit. And treasury stock, which is a contra account, so it has a different normal balance than its neighbors, it increases with a debit. When I break down retained earnings, net income is going to have a credit balance or credit impact, and dividends will have a debit impact. If I then broke down net income into revenue and expenses, revenue would have a credit balance and expenses would have a debit balance. The way most students remember it is with mnemonic. And there's a couple of them out there. You may have had other teachers that had other mnemonics. The one I like is dead clerk. So dead clerk, along the left side there, you see the debit side of the T account. What increases with a debit? Expenses, assets, and dividends. On the right side, credit is the top of that column. And what increases with a credit? Liabilities, revenue, and capital accounts, which is essentially equity. So I know that doesn't spell the word clerk correctly, but it's an easy way to kind of remember that if you need a prompt. So double entry accounting is the foundation for accounting systems, and it really requires that you look at transactions and record them in a way that every transaction is going to affect at least two accounts. You can't have an entry that only affects one account. So it's going to be two or more accounts. And the total of debits has to equal the total of credits, of course. I think you all know that fairly well. And then the entry needs to follow the rules of debits and credits so that we're increasing the correct things and decreasing the correct things. So journalizing, we record transactions in a journal. The process is called journalizing, and an entry is called a journal entry. There are journal entries that record transactions. There are adjusting journal entries where we correct balances in account, and there are correcting entries where we correct a mistake that somebody else has made. That I found in my experience as a controller, I did quite a few correcting entries where a bookkeeper recorded something incorrectly and I had to fix it. So the steps in journalizing an entry is to carefully read the description of the transaction and determine what types of accounts are involved, meaning are they asset accounts, are they liability accounts, revenue accounts, expense accounts, equity accounts, so forth. For each account that's affected, determine if the effect is an increase in that account or a decrease in that account. Then determine, based on the account type and the rules of debits and credits, if we record the increase with a debit or a credit, and then record the journal entry. And last, if there's a fifth point there, make sure the debits equal credits in that journal entry. So the format, and this is a traditional format for doing this manually, is that you record the date in the date columns. The first date column is the month, which is 3 letters. The second column is the date within the month. As you move down, you don't repeat the month until the month changes or until you start a second page. So if we had a transaction after this one that was on September 29th, we wouldn't write SEP again. We would write just 29 in the right-hand date column. We record the debits first, and the debits are left justified, the description there. So it's all the way to the left. We might include, many companies, of course, also include an account number along with the description. And then we have the amount listed in the debit column. Notice there are no dollar signs involved. This is an internal document, so dollar signs aren't included. The credit is then listed, and notice we indent about 3 or 4 spaces and record the credit, the description of the credit account, and then we record that amount under the credit column. This allows us to total both columns and confirm for the entire page that debits equal credits before we enter them in a computer system. There's also then a brief description of the transaction that's entered on the third line, or the line after the last credit. And that description is written there for 2 different reasons. One is it will remind you what it was you were doing when you recorded this entry. You might have recorded an unusual or complicated adjusting or correcting entry in January, and the auditor's asking you about it the next January when they're looking at your previous year, and it can be hard to remember what it was you were thinking when you made that entry. So recording a description, whether it's in a manual system like this or in a computer system, is really helpful for triggering your memory as to why you did something. It also lets other people you work with know why you did something. So that's a real benefit as well. So first, I want to talk about cash transactions. So I have here a small bank reconciliation that a company performed, and I would like you to record the entry to record the adjustments that are necessary as a result of this bank reconciliation. Again, that's going to cause our cash account to be adjusted so that it is in line with or equal to the adjusted balance as per the reconciliation. So please pause the video right now. On your journal entry form, record the journal entries for the adjustment shown on the bank reconciliation, and then unpause, and I'll show you the solution next. Okay, the entry you should have made is you would have debited cash for $408 for the additions to the company balance, and you would credit note receivable for $400 to reduce the note. We received a payment against it, and to recognize the $8 of interest revenue. So that would be the first entry. The second entry would be to debit bank fee or miscellaneous expense. Some companies use that for $18 and credit cash for $18. And then the last entry is to make that correction on a check that was written in error to debit accounts payable and credit cash for $9. So those are the entries that would be required to be made as a result of the process of reconciling the bank statement. The next category is accounts receivable. So I'd like you to record the transactions for the following receivable related items. First, invoice a customer for $10,000 sale with net 30 terms. Second, record the receipt of a partial payment from the customer. And then assuming that they are not able to pay the remaining $1,000, write off the remaining balance. And we'll assume that this company uses the allowance method as opposed to the direct write-off method. So go ahead and pause the video, record that entry, and then unpause. Okay, your first entry would be to debit accounts receivable for $10,000 and then credit a revenue account. It could be sales or consulting revenue or some specific kind of revenue account for $10,000. We'll record the receipt of cash. So we debit cash for $9,000 and credit accounts receivable for $9,000 to reduce the receivable. Less people owe us money now. And then I abbreviated their allowance for doubtful accounts. We'll debit that account for $1,000 and credit accounts receivable. If you had drawn a T account, you would see that if this was the only transaction, our accounts receivable account would zero out at that point. We no longer reflect that this customer owes us money. It would be zeroed out. And remember, the allowance for doubtful account is a contra account, so it has a normal credit balance. So by debiting it, we're reducing it. We have less of a provision for future write-offs now as a result of this transaction. Okay, next I want to talk about prepaid assets. So here we're going to, and first I want to make a general claim about prepaid assets. So company use prepaid assets to record an expense that they pay in advance. So maybe I'm writing a check for next year's rent in December. I pay my rent a year in advance, maybe, or in this case we have advertising we're paying in advance. So prepaid assets, that's a category that you have to be really careful about because it's easy to record something as a prepaid asset, but then not remember to come back later and reduce that prepaid asset and recognize the expense. So sometimes bad surprises can be hiding in prepaid assets that you have to resolve at the end of the year before an audit. So these are accounts that you should always be careful with and make sure that you're comfortable with the balance in those accounts at the end of every month. So here what I'd like you to do is record an invoice on April 1st that you receive in the amount of $18,000 for 1 year of advertising that will start in the month of June. The next transaction is paying that invoice within the 30-day terms. And the last transaction is recording the adjustment at the year end. So go ahead and pause the video and then unpause it once you've recorded that entry. So in this case, when we receive the invoice from the supplier or the advertiser that we're working with, we'll debit prepaid advertising. So that's a current asset, $18,000, and we'll credit accounts payable for $18,000. The next transaction, 30 days later, will debit accounts payable to take that payable off the books and credit cash to reflect cash leaving our business. Then at year end, we'll make an adjusting entry to record advertising expense. Now recognize that you also might do this each month rather than waiting till year end and doing all 7 months. So in this case, we take $18,000, we divide it by 12 to get the monthly advertising expense of $1,500 per month, and we recognize that 7 months have gone by, June through December. So that's $10,500. So we recognize advertising expense in that amount, and we pull down the prepaid advertising. So we're left with $7,500 of prepaid advertising at year end, which represents the advertising we paid in advance for the first 5 months of the following year. The next category is inventory, and what I'm asking you to do here is to record a purchase of inventory under the terms 210 net 30. So on April 1st, record the purchase of the inventory. And then on April 3rd, record that we're returning $1,000 of inventory because the product had defects. And then on April 9th, we pay the amount due within the 210 net 30 term. So we pay it within the discount term. So go ahead and hit pause and record that transaction. So on April 1st, and I apologize, I don't have dates shown on this format here, I'll debit merchandise inventory or inventory, and I'll credit accounts payable for $10,000. Several days later, when I return the inventory, I'll reverse that entry partially. So I'll reduce accounts payable by debiting that account, and I'll credit merchandise inventory to reflect that I've taken parts off the shelf and shipped them out. And then when I go ahead and pay it, I'll debit the remainder in accounts payable. So I'll zero out that account, and I will credit merchandise inventory for the amount of the discount I'm taking, because the inventory I have remaining is now I'm recognizing that it cost me a little less than what I reflected when I initially bought it. And I'll reflect that I'm sending a check out for $8,820. So the $180 is 2% of the net $9,000 that I owe after I made the return. The last category is fixed assets, and I want to give you a somewhat more complicated transaction to record for this one, and we would do it with a single journal entry. So in this case here, we buy a similar new piece of equipment that has a fair market value of $5,000. The seller of this new equipment is giving us a trade-in allowance of $1,100 on the old equipment that we're trading in, which means that we also have to give them another $3,900 in cash in addition to trading in our old equipment to purchase this new machine. Now the old equipment at the time of the sale has an original cost of $4,000, and up to that point we have accumulated depreciation of $3,200. If this transaction, see, it happened on June 19th, we would have needed to have depreciated it up to June 19th first before doing this transaction. So at that point I had accumulated depreciation of $3,200, so it had a book value of $800. We'll need to know that so that we can determine the gain or the loss on the sale. So there are 4 goals for this journal entry. The first goal is putting the new asset on the books. The second goal is to remove the old asset from the books. The third goal is to recognize the gain or loss on this transaction. And then the last objective is to record that cash is leaving the business. So hit pause and and record that entry, and then I will unpause and I'll show you the entry there. So in this case here, I put the new equipment on the books with a debit to equipment, and I've just noted new there in parentheses to keep it straight, and that goes on at its fair market value. I then remove the old equipment, so I credit equipment for $4,000, its original cost, to take that off the books, and I debit accumulated depreciation for the accumulated depreciation at that point. Remember, accumulated depreciation as a contra account has a normal credit balance, so I reduce it with a debit. I recognize the gain on the sale, which is the $1,100 trade-in minus the $800 book value. So I had a gain of $300 on trading in the old asset. So gains are recorded with a credit, losses are recorded with a debit. And then I record the cash of $3,900 that I need to pay. And then lastly, I check to make sure the entry balances, which I can see both sides are $8,200, so I'm good. This is the end of this lecture. I look forward to talking to you again when we do the same thing for liabilities and equity. Thank you.